Now let us move on. Let us continue. So we are going to continue with no, actually not continuing, but we are starting a new topic. The topic is called capital budgeting decision or investment decision. Capital budgeting decision or the investment decision. The investment decision. So let us write it. So capital budgeting or the investment decision. So some people call them capital budgeting decision, and some people call them the investment decisions. It means the same thing. So it means the same thing. So we shall start with a simple definition. We're going to start with a simple definition, and we shall be as brief as possible so that we try to cover as much as we can. Now, let us go to our notes. So, definition refers the decision, refers to the decisions, refers the decisions which which involves uh, whether or not whether or not whether or not to undertake a capital project to undertake a capital project. So we are saying these are the decision which involves decision whether or not to undertake capital projects. You know what are the capital projects? Capital projects, these are those projects which requires huge amount of money to undertake. And in most cases, the capital project are projects which are irreversible in nature. They are reversible. So those projects requires decisions. So those decisions that we make, whether to acquire to undertake these projects, is what we call the capital budgeting decision or the investment decision. So I'm using my book here. Without wasting time, the finance manager has need to do some mathematics on it to determine whether the project is viable or not. So there is need to do some working to determine. So the finance manager, the finance manager has to determine if the projects are viable or not. When the project is viable, the net benefit is positive. So when the project is viable, it means that that project is generating an inflow, is generating an extra inflow. When the project is not viable, it means it is generating losses. It means it's generating losses. Now, when the project is viable, when the project is viable, the manager can accept the project. Now, if the project is not viable, the manager rejects the project. So if the project is not viable, the manager rejects the project. So it is the question of, is the project viable or not, whether we undertake it or we do not undertake it, whether we accept it or we do not accept it. Same thing. So it's either we accept or reject. So we can only accept a project where it generate an extra income, or it generate a positive values or benefits. But in the case where the benefits are losses, we reject the project. So that's all about it. Type of project. So without wasting time, I want to be very fast. Type of project. Type of project number one, we have replacement stroke modernization project. Modernization projects. Now, these are the projects which involve changing an old machine with a new machine. So refers to projects which involves replacing an old machine with a new machine. So you have no any other explanation. So replacement, we replace an old one with a new one. So that project is what we call the replacement or the modernization project. And in most cases, we replace an old machine with a new machine because mostly of efficiency. Efficiency must be the main reason. Now, efficiency means we cannot do as per the capacity. Now, in that case, if the machine is too old, if when we bought the machine was producing 150 units per day, but because the machine has become old, it has a lot of issue, you find that it's producing 50 units per day, 50,000 units per day, meaning the machine is not efficient. So in that case, we need to replace the machine. Another reason why we tend to replace an old machine with a new machine, it is because of what we call obsolete. The machine becomes obsolete. So in that case, there's that need to replace. So let us see just some of the reason for replacement of old machine, with new machine. Now, number one, we can talk about changes in technology. Changes in technology are rendering the machine obsolete. Rendering the machine obsolete. Number two, desire to increase company's efficiency. Desire to increase company productivity and efficiency. Number three, we can talk about in case old machine becomes too expensive to maintain. In case the old machine becomes too expensive to maintain. Now, in that case, there's need to replace that machine. So when the machine becomes too, so we call them the overhaul cost. So we call them the overhaul cost. Now, overhaul cost, these are the costs that we expect. So remember the word expect. We expect to incur in the future. So those costs that we expect to incur in the future, we call them the maintenance cost. Now, ikifika hiyo wakati now we are maintaining the machine. Now, when the cost is too high to maintain, unapata the cost of maintaining that machine is too high, meaning it is eating our profit. It is eating the cost of production. Now, in that case, we replace that machine with a new machine. Number B, let's talk about mutually exclusive project. Mutually exclusive projects. Now, these are projects which cannot be undertaken simultaneously. So these are the projects which cannot be undertaken simultaneously. Okay. That cannot be undertaken simultaneously. Reason why? Reason why we cannot undertake them simultaneously, because they serve similar purpose. Because they serve similar purpose. Similar purpose. So that's number C. So tumesema we shall be very brief as possible. So what does that mean? This means that if we undertake one, we exclude the other one. We cannot do them at the same time. So if we undertake one of the project, we exclude the other one. So if you have two projects which are mutually exclusive, it means we undertake one at a time. So if you undertake one, we exclude the other one. That's what we call the mutual or the mutual divisible project. Divisible project. Now, these are the projects which can be undertaken in bits but generate revenue. So those projects, we call them the divisible projects. We can divide them into portion, but remember, we can undertake them in portion, but remember, each portion can generate revenue in the process. So we write and say, before the project which can be undertaken in stages, these are projects which can be undertaken in stages. What does it mean? I.e., it can generate revenue before completion. It can generate revenue before completion. That one is okay. That one is fine. Let's go to the next one. Indivisible project. Number D. Indivisible, opposite of the divisible projects. Now, these are the projects which cannot be undertaken in stages. They cannot. We need to complete them in full so that they generate revenue. So you can say, refer to the project which cannot be undertaken in stages. Refers to projects which cannot be undertaken in stages, i.e., it cannot generate revenue unless completed. It cannot generate revenue unless completed. That one is okay. Now, before we go to the part D, there's something we need to write down. You allow me to write. And NB, and that one is purposely for the divisible project. So you need to know this one for divisible projects. So divisible projects are normally occurs where the company has insufficient funds to undertake all the viable projects. So in the situation where the company has insufficient funds, to undertake all the viable projects, then we can use the concept of divisibility. So if the project can be divisible into portion, we can allocate the money that we have to do some portion. Then when we get an extra money, we can continue with the other portions or with the other stages. So that's called, it's applied in the concept of insufficient funds. So this insufficiency, this insufficiency of funds is called capital rationing. Is called capital rationing. So let me use this ink. It's called capital rationing. So capital rationing. So capital rationing is a situation where the firm, the company does not have the enough or the sufficient amount of money to undertake all the projects which are viable. So the keyword there is the word viable, which are viable. Okay, for now tunawachia hapo, tunaendelea in part D, part E, oh sorry. Part E, we can go to dependent project, dependent project, dependent project, dependent projects, and we say they are also called complementary projects, also called complementary projects. So I think now we can define it, and we say refer to the project which give rise to other projects. So refers to the projects, refers to projects which give rise to other projects. A good example to other projects. A good example is a university or a college. So when the government or when the private person or private sector decide to open a college somewhere in a particular place, now it will lead to an emergency or an emerging of another uh, related project. For example, if you open a university, it means that the student will need a place to stay. So we shall give rise to the rise of shopping centers, accommodation centers, and so on. So that's a good example. So refers to the projects which give rise to other projects. So when a university is open, it will give rise to shopping center, accommodation center, restaurant, and so on. That's a good example. So call them the dependent projects. F, independent projects. Independent projects, and we say independent projects. We say that these are projects which cannot be undertaken simultaneously. These are the projects which cannot be undertaken, which cannot or can, which can be undertaken. Supposed to be can undertaken. So which they cannot ndio hii for mutual. For this one is can. So these are the projects. These are projects which can be undertaken. Can be undertaken simultaneously. Simultaneously. Because they serve different purpose. Because they serve different purpose. Because they serve different purpose. So that's all about it. Because they serve different purpose. That's all about type. We shall concentrate with those, just those. No extra type. But we have many. But for this part, those will be our focus. Let me see if we can add any other. But that one is our focus. We don't need to add more or less on that. So mutual exclusive project, independent project, dependent, divisible, indivisible, replacement. Maybe we can talk about acquisition projects. Acquisition project, which is the last one. Acquisition project. Now this is the opposite of replacement. So replacement means we replace an old one with a new one. But acquisition, we acquire a new one, meaning we don't have any old machine. So we are acquiring a new machine. So we say involve buying a completely new asset. So these are the projects. These are the projects which involves completely buying a new asset. Buying a new assets. Buying a new assets where none existed before. Where none existed before. So kumaanisha ni a completely new item. So a completely new item. So those are the items or the types of the projects that we can utilize in this topic. Now let's talk about characteristics of these projects. Characteristics. So characteristics nitaziname tu hapa chini yake. Characteristics of capital budgeting projects. Of capital projects. Now, one of the characteristics is that they are long-term in nature. They are long-term in nature, number one. They are long-term in nature. So meaning, when you undertake them, you shall do it for a very long time. And the benefit, so remember the benefit or the cash flow to be realized from this project is in the future. So kumaanisha, so this project is a very long-term project. Even before you start realizing profit, they require huge amount of capital investment. So another characteristic, they require huge amount of capital investment. Stroke fund. So they are very expensive in short. They are very, very expensive. And then benefits or cash inflows are expected to be realized in the futures. Are expected. So when you do are expected to be realized in future. So that tulikuwa tumeshasema the benefit are expected to be realized in the future, meaning if we undertake this project today, we shall receive some cash flow in future. So those cash flows are the benefits, and we expect them in the future. Next, they are irreversible. Kumaanisha if you start undertaking them, you cannot reverse them. So the project are irreversible. So mimi naandika in short, so as to save time. So they are reversible in nature, and then they are highly risky. So the project are highly risky. Number 6, we can talk about the project are uncertain. The project are uncertain. What else can we add? I think those are enough. Let me see in my book if we can add. So tumesema long term, they are very expensive, which they require a huge amount of money. They are risk and uncertain. They are reversible. They are complex and involve difficult decision. They are complex and involve difficult decision. They are complex and require difficult decision. So we can say number 7, complex and requires difficult decisions. So they are complex and requires difficult decision. And then you can also say they affect, so acha niweke hapa number 8. They affect liquidity position of the company. Liquidity position of the company. So they affect the liquidity position of the company. Then the last one, which we can also add, is they affect the risk profile and perception of investor. They affect the risk profile, and perception of the investor, and perception of investors, So that is all about the definition of capital budgeting, the types, and the characteristics. I think that one we are clear. Now we can go to the appraisal technique of capital budgeting. 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 So project evaluation technique. So we have two methods. We have the modern method and not modern. We have discounting and non-discounting. So um, this involves, so we call them the appraisal technique. So other people call them appraisal. You come even in appraisal. Technique. Confirm the spelling, but I'm more still conversant with the project evaluation technique, and we can say that this involves cost benefit analysis. This involves cost benefits analysis. Use the word analysis. Yes, analysis to determine whether to accept or reject a project. So we have the include, so we have the non-discounting. So let's call it A, non-discounting, or the traditional technique. And then we have the discounting, or the modern. So let's have the non-discounting technique. Non-discounting technique. Now these are techniques which do not, which ignore. Sorry. So these are techniques which ignores time value of money. So you say this is a technique, which ignores time value of money. Now you remember when we were doing the time value of money topic. So remember our topic in time value of money. So when we are doing it, we talked about compounding and discounting. So compounding and discounting, those are the items which we are talking about. They consider time value of money. Now, when we be talking about non-discounting technique, the discounting aspect is not there. So we shall not consider the discounting of cash flow. That is conversion of future cash flows to present. We talked about discounting very well in our time value of money. So I think that one is not an issue. So if you have an issue with that, you can revisit back our video of time value of money. But for now, that one is enough. So they include A, ARR, which is the accounting rate of return. Accounting rate of return. Accounting rate of return. Rate of return. And number B, we have the payback period. We say payback period. Payback period. We start with the first one. We start with number A, ARR. We start with number 1, ARR, before we go to payback period. ARR. And we say this method uses accounting profit. This method uses accounting profit. So this method uses accounting profits to evaluate projects. To evaluate projects. To evaluate project. So this method uses the accounting profit to determine the viability of the project. So it uses the accounting profit to determine the viability of project. Let me go to part of it. How do you get the ARR? ARR is equal to the average accounting profit. Average accounting profit divided by the average investment times 100. So ARR is equal to the average accounting profit profits over average investment times 100%. So that is it. But remember, the profit NB, the profit used to determine average accounting profit is profit after tax. Profit after tax. Aya. How do you get the average accounting profit? Average accounting profit. This one means average accounting profit. AAP. Average accounting profit. Average accounting profit is equal to total accounting profit. Total accounting profit over number of years. Then we need average investment. So average accounting profit in here. Then average investment, AI, average investment, initial outlay plus the salvage value divided by 2. But remember, when we talk about the initial outlay refers to the cost of investment. So remember, that one refers to the cost of investment. Initial outlay means cost of investment, So initial outlay is the cost or the cost in present value that is required to undertake a project. So total cost. So initial outlay refers to the total cost of the project. Salvage value is the value realized when the asset is being disposed at the end of the useful life. So one is at the beginning, the other one is at the end. So when we want to undertake a project, we incur cost. So for example, kama tunataka kununua machine, so that machine itakuwa ina produce some units. So when we buy that machine, the cost of buying that machine is what we call the initial cost or the initial outlay. But when we use that machine for some years, then we want to sell it or to dispose it. So the value we dispose it, we call it the salvage value. So we call it the salvage value. Decision criteria, decision criteria, decision criteria, decision criteria. So let us use this one when IRR is greater than cost of capital. So IRR, when accounting rate of return is greater than cost of capital, accept the project. Accept. Number B, when ARR is less than cost of capital, we are supposed to reject. But when ARR equals to cost of capital, then no valid decision. So in this case, no valid decision. So point of indifference. I will say no valid decision. No valid decision. Meaning it's a point of indifference. It is a point of indifference. Point of difference. We can say point of indifference. Meaning no valid decision. Point of indifference. Now let us look for a question in our past paper. Just one question for IRR, and it is only one which appears, which we tested the other day. Reduce it to happen. So I'll do it on the other side. So let us go to our past paper. Let us move on to let us go to our past paper and go to December 2024. December 2024. Not December. August 2024, question number 1C. August 2024, 1C. August 2024, question number 1C. Question number 1C. Do it faster. So the question reads, so More Ltd is considering a project which requires an initial investment. Initial investment is an initial outlay of 156,000 in the machinery. The machinery will last for 4 years, after which it will have a scrap value of 26 million. So it also 26 million, that's the salvage value. Additionally, investment in working capital will be required of 195. So we shall have our working capital, which also will form part of the salvage value. That one will form part of the salvage value. The expected profit before depreciation is as follows. So we have it there. So the annual profits before depreciation. Tuko nayo hapo. That one is okay. I think we need to raise depreciation in that case. Now, after depreciation, determine the accounting rate of return. So require determine the accounting rate of return and advise whether to take the project or not. So let us do it together. So let us do it. So we start with finding the average accounting profit. Now, before we find the average accounting profit, we need to find the profit for each year. So we have the years. Years. So we have 1, 2, 3, and 4. I think you can share year 4. Then you have the earning before depreciation. So earnings before depreciation and tax. Because the EBITDA 58,500, 58,500. Also 58,500, 58,500, 52,000, 52,000. Now 32,500 is in thousand. 32,000. So the question is in thousand. So we need to less depreciation. Let us do a working for depreciation. Now depreciation, remember, it is the cost. So remember, depreciation is equals to cost minus salvage value over number of years. Number of years. So the cost, the initial cost ni ngapi? 156,000. So tuweke in thousand because the question is in thousand. Correct, to me 156,000 minus salvage value of 26,000. 26,000 divided by the 4. So that is the depreciation divided by 4 because it will be there for how many years? For 4 years. So 156,000 minus 26,000 divided by 4, which is 32,500. 32,500. So we less 32,500. 32,500. 32,500. 32,500. So earning before tax. Earning before tax. Need to get earning before tax. So tunasema 58,500 minus 32,500. 26,000. So is 26,000. 58. So in 26,000. 52,000. 19,500. Then you have a negative of cash flow of minus 500. You're supposed to less tax, which is 30% in Kenya, because we are in Kenya, so that we get profit after tax. So that I can get profit after tax. So 30%, 0.3 times 26,000. So you're supposed to have 7,800. So 26,000 minus answer 18,200. same here, 7,800. 18,200. I will need 0.3 times 19. 19,500. 5850. 5850. 19,500 minus answer 13,650. Now when we have a negative cash flow, tax is 0, but our profit after tax will be negative 500. So we cannot pay tax where we have a negative figure. So we cannot pay tax where you have a negative figure. So let us get the average. So the average, so average accounting profit, average accounting profit, average accounting profit, AAP, average accounting profit, average accounting profit is equal to total accounting profit. So total tuna add zote 18,200 plus 18,200 plus 13,650 plus minus 500 in negative, divided by the number of years or the useful life. Change this one to useful life. Use the word useful life. The equivalent useful life is 4 years. Use the word useful life. And pia hapa useful life. Useful life. Itakuwa ngapi? So itakuwa ni 18,200 plus 18,200 plus 13,650 minus 500 divided by 4. So mimi napata 12,387.5. So tumemaliza na hiyo. So tuende kwa average investment. Now average investment is equals to the hapa initial outlay plus salvage value. So initial outlay to tuliziona ni 156,000. Make in thousand 156,000 plus salvage value. Now salvage value we need a working. So this is the formula. salvage value. Our salvage value itakuwa the value of the salvage value, the scrap value plus working capital So kumaanisha itakuwa ni 26,000 plus 19,500. So 26,000 plus 19,500. 45,500. So 45,500 divided by 2. So 156,000 plus 45,500 divided by 2. 100. 750. Now, with that one, we are confident now to get the IRR. So let's get the IRR. So as your ARR. So let's get ARR. So our ARR formula ndio hii now. The accounting profit average, which is 12,387.5 over 100, 750 times 100%. So what will be the figure there? Tutasema 12,387.5 divided by the 100, 750 times 100. Napata 12.29%. 12.29%. Decision criteria. So we need to give the decision criteria. Criterion. Now we said that when ARR is greater than the cost of capital, we accept. But when it is less, we reject. When it is the same, we do not have the valid decision. Now in this case, our ARR is 12.29%, which is less than what we have the required rate of return. The required rate of return is 15%, which is our required rate of return is the opposite of cost of capital, which is less than 15%. So what is the decision? We reject the project. 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 So that is that one. So nilisahau kuchange hapa juu. You never told me. It's a investment decision topic. Investment decision topic. Investment decision. Investment decisions. So that one marks the end of ARR. So there's no any other question in our past paper concerning ARR. So there's no any other question concerning ARR in our past paper. So let us meet for lesson 2. We talk about the payback period, so that we can talk about the payback period. So up to now, I wish you well.